Good day, ladies and gentlemen, and welcome to the Nedgroup Investments Flexible Income Fund update. All participants are currently in listen-only mode, and there will be an opportunity for you to ask questions later during the conference. If you should need assistance during the call, please signal an operator by pressing star and then 0. Please also note that this call is being recorded. I would now like to hand the conference over to Rob Johnson. Please go ahead, sir.
Good morning, everybody, and thank you very much for giving us your time on this dreary Cape Town morning, and also a day of volatility in the bond and currency market. So we have Rashad Tayob with us today, the manager of our Nedgroup Investments Flexible Income Fund, a fund that has had a very good performance year to date. And rather than give you a bit of an update on the fund, Rashad's going to talk through some of the big global factors that are impacting their thinking when they come to managing the portfolio. So without further ado, I'll hand on to Rashad, and as the gentleman said, we've got plenty of time for questions at the end, so don't be shy.
Thank you, Rob. Good morning, everybody. I'm glad we were able to make the time to do this webcast specifically today because you are seeing a repricing in the market, and we have now begun to see that the topic is the impact of rising global rates. And in the last few weeks, you're now beginning to see the real impact of the moves that have happened over recent months in terms of the Fed as well as the ECB's announcements. So what have we seen over the last decade? Over the last decade, we've been in a zero or even negative rate environment. So investors have become very used to a certain paradigm whereby the cash it was very difficult to hold cash. You were getting zero, or in Europe, for example, you still are getting minus 0.4%. So there was always this chase for risk and chase for yield, and patience was not necessarily rewarded. Now, that has definitely changed over the last 2 years, but as in life, as investors, it's very difficult to give up the habits and change habits which have accumulated over a long period of time. The environment has definitely shifted, the risk-free rate in the U.S. has gone up substantially, but investor behavior over the last 2 years has not shifted. There's a continued chase for yield, and you aren't able to. The risk premiums that you're seeing in the market are still at extremely low levels. This slide of people with their head in the sand, I think this captures what EM investors are like in 2018. Over the course of the last 2 years, global rates have moved up quite substantially, but EM investors have basically put their head in the sand and continued to chase risk and chase yield. They haven't adapted to the new paradigm, and it's only in the last few weeks that people are waking up to the realization that the global liquidity environment has shifted. In fact, we're beginning to see a little bit of panic from some of the more nervous investors in the emerging market space. So what do I mean by the global liquidity environment? This is a chart of global money supply outside of the U.S. It's at the global dollar market, and you can see that money supply has moves up quite substantially during the quantitative easing periods, QE1, QE2, and in recent times, China and the ECB and Japan have moved global liquidity, quite significantly. However, once they pull back on these quantitative easing programs, global liquidity then begins to fall, and the money that has been chasing assets begins to need to be shifted out. And what we've seen that over the course of this year, and it's beginning to accelerate. So the question is, what is driving this pullback in global liquidity, and whether it will continue? Firstly, what's driven the pullback in global liquidity? It's the fact that you can now earn a risk-free rate in USD. For a long time post the financial crisis, you got nothing in terms of USD. What I've got here is the chart of the US 2-year asset, and I'm going to reference that US 2-year government bond a lot over the course of this presentation, because for us, what it represents, it's an asset with very low levels of interest rate risk. It's only 2 years, it's quite short, and it's very low credit risk. It's issued by the U.S. government. It's essentially a risk-free return, and whereas before you were getting about 0.2% on it, you're now getting a nice yield of about 2.5%. So you are getting something on a risk-free asset in USD, which means that the need to chase risk and chase yield has diminished. However, as I said, investor psychology hasn't necessarily changed, even with this massive shift up in the risk-free rate that we've seen in the last 6 months. The question of whether this risk-free rate continue to rise depends on whether the Fed continues on its hiking cycle, and that, to a large extent, depends on U.S. inflation. The question is, are we out of this low inflation period? I believe that we are, and it depends on whether this higher level of inflation is maintained. So we're definitely above the 2%. We're currently sitting at 2.5% on U.S. inflation, and it will tick up due to cyclicality in the coming months. So we are above the Fed's 2% target. The question is whether we get a material rise in inflation, and what happens to the market if inflation gets stuck at closer to 3%, and how does the Fed react in that circumstance? I think the risk of high levels of inflation have definitely increased in the U.S. because you've got unemployment has fallen back below the levels of 2008. It's actually close to the levels of 2000. You can see that the broader definition of unemployment is down at 7.6%. If we use the more narrow definition, it's actually down at 4%. So the U.S. economy is very close to full employment, and you're seeing on the right-hand side of that chart, you're seeing that effect coming through in terms of wage growth. It's the highest. It's 2.8% year on year. It's the highest that you've seen over the last 10 years. And if it wasn't for technology constraining wages, so the effects of automation, the workers have less bargaining power. If it wasn't for that, I think wage pressure would have been even higher than this. So the question is whether that's maintained, and if it is, inflation sitting closer to 3% is a reality, and we're going to have to. It'll be anybody's guess what the Fed does in that type of environment. This is a very interesting chart showing you the tightness of the labor market, job openings versus number of people employed. You can see that it's actually below 1. We haven't seen that in a very long period of time since early 2000, and that is essentially the number of job posts. You've got more job posts than the number of unemployed people in the U.S. It's a very strong, very tight labor market, and we're seeing that. I've sat in on some of the company meetings that the equity guys had. One of the meetings we had even a year ago was with Sasol. They're doing a big project in Louisiana, which has been delayed, and that 1-year delay increased the cost of that project by over R1 billion, which was a very substantial number. And what they said was, that delay caused a lot of wage pressure. That extra R1 billion was purely the amount that they had to pay in additional wages to construction workers, to engineers, because of how difficult it is to find workers in the U.S. So definitely the bargaining power of labor is coming through, and we're seeing that in the quarterly comments. I just got, if you look at the recent quarter, almost all the S&P 500 companies are referencing the increase in wages. I've just got a few examples from Walmart, Target, Foot Locker, etc. And I thought this slide was quite interesting because it's a very American way of speaking of things, because they all refer to investment in wages. In the rest of the world, wages are an expense, but they like to do a bit of spin there and talk about how they're investing in wages and high compensation. But essentially, there's definitely a lot of wage pressure coming through in the U.S., and that's going to impact negatively on inflation. So the tide of liquidity is definitely going out because rates are moving higher. And I think there's a famous Warren Buffett quote, which everyone knows: only when the tide goes out do you discover who's been swimming naked. I think we're going to find that out. But who are the candidates for who's been swimming naked? In the EM space, I think there are a number of candidates. Just a few examples. Argentina, over the last 3 years, has issued $100 billion worth of USD-denominated debt. This is a country which has been in default for more than half of the last 100 years, but last year investors decided to buy a 100-year bond at a yield of around 7%. a very speculative investment. So there's a lot of, in an environment where risk premiums were very low, people were chasing, where the risk-free rate was very low, people were chasing any type of return they can get. And we know through history that it's very dangerous for emerging markets to issue bonds in foreign currency. They've done $100 billion, and if you look at the currency chart on the right, their currency has depreciated by 50% just since the beginning of the year. So you think about what that does to their debt ratio in a handful of months when you're running that type of strategy. There's a reason why foreign debt in emerging markets is referred to as original sin. It seems like the market never learns its lesson. Sub-Saharan Africa, all our neighbors have issued a huge amount of debt. Mozambique, Zambia, Ghana, all these countries have issued debt where their debt levels are now back to the bailout level, which happened about 10 years ago when Bono and the World Bank and the Pope all got together and said these countries are too poor to service their debt, we need to write it off. They did that 10 years ago, but all that happened is that they've basically borrowed that money all over again. They've got more debt than they do 10 years ago, and we're approaching the levels where we need another bailout. Mozambique has already stopped paying their bonds about a year and a half ago. They've already defaulted. Those bonds are still trading at around 90 cents on the dollar, but I think those investors need to take a look and, when they look at that closely, they realize they're definitely not getting 90 cents back on the money that they've lent to Mozambique. Brazil is another interesting case study where they had a change in government and were the darling of emerging markets, but the reality is, even though they spun a good story, they continue to run 10% budget deficit, which makes our 4% and 4.5% budget deficit look very good in comparison. But they've only reduced now in the last year their budget deficit to 7.4, but they've taken their debt just since 2014 from 51 to 76% of GDP, and in the last 2 days they've had to tap into their reserves in order to defend their currency. Also, if you look at history of emerging markets, Thailand, even the British pound, when you start to use reserves to try and defend your currency, it's a very dangerous strategy. You're actually putting a red flag to all the hedge funds and global investors out there that you need to be, that you should be putting a target on your back. It's quite a foolish thing to do. And then emerging markets in Europe, you've got Italy, which has got a new government, a combination of socialism and fascism, combined with 130 debt to GDP ratio, and a government which has wants to announce tax cuts and a social grant system. It's a very toxic combination, and the sell-off I think investors have a very short memory, because Europe went to the wire twice in 2011 and 2012 with Greece. That was a relatively small country in the European sense. Italy is the third biggest bond market in the world. If they had to go to the wall, it would be catastrophic, not only for Europe but the global financial system. And then South Africa, it's questionable. We have had a lot of reform. There's been a nice turnaround under Cyril Ramaphosa, but it's going to take a lot in order to undo some of the damage that we had for almost a decade under the Zuma administration. And we've talked a lot on the Nedbank roadshows, and I've talked a lot about how the fundamentals in South Africa have deteriorated. Like Brazil, we've been spinning a good story, but to be honest with you, we have not actually delivered in terms of the numbers. And in South Africa, I think we're unlikely to get real reform until post the election, which is in a year's time. So we're going to be in limbo, and the question is whether the market is going to be forgiving enough over the next year while we continue to delay some of these reforms. EM debt has grown massively. This is the dollar market value. Even in the last 2 years, you've seen about $400 to $500 billion combined in terms of EM corporates and EM sovereign. That is a lot of debt which has been issued, and the reason for that is that the foreigners, the developed market investors have been chasing yield, and they have been demanding debt. That story has begun to turn around. You're beginning to see the impact of that. Just in the last 2 days, the rand has moved 50 cents. As foreigners begin to unwind these emerging markets holdings they've accumulated over the last 2 years. You must remember 2016 was a record inflow into emerging markets. The market got to expensive levels. 2017 beat the 2016 record. So we've had a combined 2 record years in a row of emerging market inflows it's a precarious position if just a portion of those inflows had to unwind. Foreigners now own more than 50% of the bond market. We saw them, buying in aggressively, even as bond yields of 186 got down to 8 and below. They were chasing. They were looking down, for another 50-point rally. When the market moved from 8 to 850, they all got a bit nervous. They started to do investor trips to find out what's going on. The fundamentals look good, but the yield was not. But the yields are moving upwards. And the reality is, fundamentals matter over the longer term, but in the short term, the money flow had just chased these levels, these yields down to very expensive levels. You're now this morning sitting at the 186 at 9%, so it's backed up over 100 basis points from the low levels, and that's a level where we've now begun to be buying in again. So if you look at even this morning, we've been doing some trading in terms of buying in because it now offers value again. At 8%, we were happy to be selling it. We were happy to be bidding out while the foreigners were chasing it. Now that they're selling it, we want to be buying in now that it's at more attractive levels. The last two charts, I'm going to apologize in advance because they are a little bit technical. Now, as I said, I'm going to be talking about the U.S. 2-year yield because that is the risk-free rate in the market. It's got very little interest rate risk. It's got very little credit risk. It's issued by the U.S. government. So when we're talking about the risk-free rate, I'm looking at what can I get as a spread? What can I get as a pickup relative to that risk-free rate? So what I've got here is the EM index yield. It's EM bonds issued in dollars above the 2-year government bond. Now, what that represents is two risks. Firstly, you're taking credit risk because you're going into emerging markets, which are all hovering around the investment grade, sub-investment grade level, as opposed to taking U.S. government risk. So you're taking, firstly, credit risk, and then you're taking duration risk because you're going out of 2-year and you're going into the 10-year space. So you're taking two types of risk. And what am I getting compensated for interest rate as well as credit risk? At the moment, it's just a touch above 2%. Now, if you look at that versus the last 5 years, it's substantially lower than what it's been. It's averaged around 3.5%, even up to 4 and 4.5% is where it offers value. So 2% is very compressed, and that's what I mean when I say that risk premiums had compressed to what I think were very illogical levels in 2017. The chase for yield caused assets to get very expensive, and once it got expensive, foreigners continued to buy it because of the story of the turnaround in Brazil, the South Africa story, etc. And I think that's very dangerous when you throw out valuation and you begin to look at stories, because now the stories have begun to weaken a bit and the valuation is at extremely stretched levels. So on the dollar debt side, emerging market, very expensive. On the second chart I've got here is the SA risk premium. I'm now bringing it back to local currency debt. The first chart was dollar debt. And I'm taking the ZAR 10-year bond, so the 186, for example, and I'm comparing that to the U.S. 2-year government bond. So what risks am I taking there? Firstly, I'm taking credit risk because I'm going out of the U.S. and I'm investing in South Africa. I'm also taking interest rate risk because I'm buying longer bonds versus a shorter 2-year bond. So I'm taking interest rate risk, and then I'm also taking currency risk because I'm going out of the dollar and I'm going into the rand. So these are three risk premiums that I've combined here. And what yield pickup am I getting? It's about a 600 basis point, a 6% pickup. Now, if you look at that relative to the last 10 years, you can see that in 2017 it rallied to extremely low levels. Previously, average about 7.5, even up to got up to 8%. That's the value type level. It was trading close to the 5.5% level. It has picked up recently. In fact, in the last 2 days since this chart was prepared, it's actually moved closer to the 7% level, and that's the reason why we've been buying yesterday afternoon and this morning as the risk premiums have increased. So over the last 2 years, spreads have really diminished. Risk premiums have compressed. There's been an illogical, irrational chase for risk and chase for yield, and I think investors were focusing on the return on their capital. So buying into an Argentina 100-year bond just because it's got a 7% dollar yield, you really focused on the return of on your capital rather than whether the Argentina is actually going to be able to service and even redeem that bond, which is the return of your capital. The shift that we've seen in the last few months as liquidity has come out is that investors are looking across the world and saying, wait a minute, Argentina, Brazil, is my money actually safe there? If I invested in a Zambia or Mozambique bond, am I actually going to be getting my money back in 2 or 3 years' time? And actually the answer is maybe. And in fact, a lot of the answer in the sub-Saharan Africa is that definitely no, you're not going to get your money back because these countries cannot afford to service their debt at the moment. And some of them can't afford to service their debt, and almost all of them will not be able to pay that debt unless they issue new debt. So investors are looking at this now and saying, if I need to look at the return of my capital as opposed to the return on my capital, I'm not liking what I see, and can I get out of it? Unfortunately, with 2 record years of inflows into emerging markets, there's a lot of money that's coming in, that has come in, and when you need to get out, there's a repricing which needs to happen. Now, that helps us because that repricing, as money exits, risk premiums widen, begin to offer value again, and we can then buy into assets at cheaper levels, which has been our strategy over the last decade. And if you look at the market at the moment, I think it's giving us some opportunity and will give us opportunity over the course of the year to buy into value, now that it's materializing. So, I think that's it in terms of the slides. We got a little bit technical there at the end, but I just want to demonstrate risk premiums, the risk premiums that are in emerging markets, and we can look to take questions if we have any.
Thanks very much, Rashad. I don't think the new Italian government are going to be very pleased to be already referred to as an emerging market, but I have one question, and can we open it up to questions first so we can start lining them up, please?
Of course, sir. Ladies and gentlemen, at this time, if you do wish to ask a question, please press star and then 1 on your touchtone phone. If you decide to withdraw your question, please press star and then 2 to remove yourself from the queue. Again, if you wish to ask a question, please press star and then 1.
Okay, so while we're waiting, Rashad, I think one of the reasons a lot of the developed world money or assets have been coming to the emerging world is because of real yields. And now we're looking at the current inflation print in SA at 4.5, and you brought up the chart of the US inflation up at 2.5. If you've got a spread of 650, does that not still offer attraction to developed market investors if you've got such a big real yield with a lower inflation differential?
So I think that this has been a bit of a contention, or at least a disagreement we've had with the market in general over the last 6 months. It's the difference between cyclical and structural inflation. So in South Africa, we've had a good downward trend in inflation. So cyclically, inflation has been coming down, and with the recovery in the rand, it's allowed inflation to get back down to that 4.5%. You then had the Reserve Bank make a lot of comments about inflation being re-anchored lower. Lesitja has given a number of speeches, but that doesn't mean that structural inflation is down below 4.5. In fact, by our calculation, structural inflation is still sitting at about 5.3, 5.4%. If you look at the increases that are coming through on a consistent basis, you've got Eskom threatening to strike here. They want 15%, and Eskom is offering 0. You look at where wages are settling. We had a very strong rand and a very low oil price, which really helped us. That's turned around massively in the last few months. So we think that given the productivity levels in the economy, structural inflation is still closer to 5.3 and maybe even 5.5%, and therefore that real yield on our repo rate, which is where they've cut the repo rate in South Africa, they've cut it down to 6.5%. That real repo rate is actually at the lower bound. Normally, we've averaged closer to 2%. 1% is manageable, but it's not necessary. It's still at the lower end of where we're comfortable with. If you look at our interest rate cycle and the fact that we've been cutting rates, whereas just in the last week, Indonesia, India and Turkey have hiked rates. So the trend has definitely been upwards. They're expecting now Mexico to start hiking again next week. So you've had a huge amount of number of emerging markets begin their hiking cycles, and the illusion in the South African market is that we're in a cutting cycle. We just never agreed with that. I think people are going to look at, the Turkey, for example, sitting at 17.5% interest rates. That's quite a significant gap, 11% gap to where South Africa is at the moment. A few months ago, that gap was 1 or 2%. So there's a very serious risk that the global market looks at our 6.5 and says that you cannot be having rates at 6.5 lower than Mexico for the first time ever. Lower than almost any emerging market. You're beginning to look quite a little bit odd in the emerging market context.
Okay, thank you. Are there any questions, please, Chris?
We don't have any questions at the moment, but ladies and gentlemen, again, if you wish to ask a question, please press star and then 1.
Shad, hi. It's just amazing that if you look at where US yields are, the majority of the world is actually yielding below it, and yet the US is actually rated higher than the majority of the world. So it's quite a big distortion there. Like, do you see that changing, and what would be the catalyst?
So, the U.S. has been a little bit ahead of the cycle in terms of firstly implementing QE, which they did in 2011, 2012. The ECB at that point was quite conservative. They then, ended quantitative easing around the taper tantrum level, and then ECB started doing quite a bit of quantitative easing later, which pushed their bond yields lower. You now have the U.S. tightening in terms of, winding down quantitative easing and rate hikes, while the ECB, it's announced that it will make a decision on unwinding QE, but at the same time, their deposit rate is still sitting at negative, at minus 0.4%. You've got still a lot of quantitative easing in the Eurozone, and what that means is there's been a strong bid from the central bank for any euro-denominated bonds. So it was illogical that a month ago, Italian bonds were trading at about 1.2, 1.3%, while the U.S. Treasury was at 3%. On a 10-year horizon, who wants, Italy should be paying a risk premium with their debt problem, as opposed to, as you said, it's illogical for their yield to be so far below the U.S., which is probably the highest credit quality in the world. It's the benchmark currency. So it is illogical, but it's just explained by the fact that you have a buyer out there who is price insensitive. They just buy. They're there to support the Eurozone. They're there to buy at whatever level. They're essentially printing money to buy it, so they don't have a profit motive. And you've had this bid in there, and I think it was a great opportunity for everyone out there to be selling, bonds into that, and selling your bonds to the ECB and being able to get out. Though obviously the Italian bond has popped up to now 3%. It's still the same as the U.S. Treasury, but even at these type of levels, if the ECB is not buying, then you do not want to be holding this bond, even at 3% in line with where the ECB is buying it. Mm-hmm. So we've looked at a number of these Eurozone countries. Spain has had a decent recovery, but they moved their debt to GDP ratio from 30% up to 100%. Post-financial crisis. So Spain is a highly indebted country. In their recovery phase, their debt to GDP has gone from 100 to 98 in the last 3 years, and they're being spun as a safe haven. So in the recent sell-off, when Italy and to some extent Portugal had sold off, Spain has actually done all right, because now Spain is actually in line with France and Germany as some of the more solid countries. But that's just the perception of the market at the moment. In reality, Spain is still a highly indebted and highly risky country, and you're not seeing any risk premium in Spain. So I think that's a country where if you're holding those bonds, if you can sell it to the ECB now, you need to be getting out of it.
Okay, thank you very much. One last chance then, please, Chris. Are there any questions on the line?
No questions in the queue at the moment.
Okay, well, on that note, just like to say thank you very much for your time, Rashad, and thanks to everybody on the line for joining us. I hope you found it useful. Thanks very much. Have a good day.
Thank you very much. Ladies and gentlemen, that concludes this conference call, and you may now disconnect your lines.